Eric Beyrich joins us, Co-Chief Investment Officer of Sound Income Strategies. Eric, thanks for being here on the Schwab Network.
Hi, Oliver. Thanks for having me. What would you like to talk about?
Yeah, give me some sound income strategies. Do you do it through equities or you do it through bonds?
We do it through both. We've got about $3.5 billion. I'd say probably 75% of that's in fixed income, but I'm the equity guy. So I'm the guy that buys the value stocks that are working this year. On conflation with some of your growth stock investors who are all down, we're up. And we pay high dividends to our clients, and they're happy about that. So this is the kind of year we actually thrive. When growth stocks get overbought and they start to go in the southerly direction, we shine, and that's what it's looking like this year is going to be for us.
The strategy seems pretty in vogue right now, not to mention a possible competitor, but yesterday we had the team from T. Rowe Price on. They just launched equity hedged ETFs and income equity ETFs as well. Basically a strategy looking at value stocks that have lower beta to the market and then collecting income on them. Do you worry about the trade getting crowded, or is it so underpriced that it could have a long way to go?
I'm not at all worried about the trade getting crowded. Those copycats, they're taking our low beta, high yield strategy. The people like to talk about growth stocks. And listening to your program, you're among them, and that's all. It all helps us because growth stocks got grossly overvalued. And I sent you guys a chart which basically shows the ratio of value to growth. Anytime the multiple that value trades at versus growth gets to be so low, it's almost a tell signal. And so we got to extreme levels of valuation on growth stocks last year. There's still a long way to go to get to the normal relationship. So I think value is going to work for a while. And it's not that growth stocks are bad things. They just got overbought. And now we're just having a normal sort of reversion to the mean kind of correction.
Do you see the broad market rising and these companies leading, or do you see these companies as thriving in a kind of stagnant stock market where they more outperform while other things are down?
First, you have to define what you mean by the stock market. Most people
S&P 500.
It's not the stock market. That's a cap-weighted index.
Sure, it's our biggest five. It's kind of the benchmark.
Well, as people look at it as a benchmark, and we love that people look at it that way because it makes it easier for us.
Yeah.
The S&P is going to have a down year, but I think the average stock is going to have an up year. And that's because of all those Magnificent Seven names that were so grossly overpriced now coming back to normal. And I don't know if you look at put call parity or any of the AAI indices. Well, the market over this weekend was the most bearish sentiment that we've seen on put call parity and the American Association Individual Investor Survey, which is actually a buy signal for a bounce. And we're seeing some of that relative strength here. Stocks try to bounce despite all the media hype over tariffs and things. So, stocks got a little oversold. They're going to bounce a little bit. But overall, as the growth rate slows in the economy and the growth rate slows for those mega cap tech names, we're going to see people look at valuation more, bunker into yield more and more the safety areas of things like utilities and healthcare and consumer staples. And those stocks will do fine. They'll have a positive year. But the tech stocks will have a negative year just because they got overbought, not because they're bad companies. We have nothing disparaging to say about them. They're just too expensive.
Yeah, fair enough. Expensive, though, for some reason because of that growth there. I wonder if the rotation you're talking about, which has been taking place here, needs a big catalyst. Some are arguing it's Trump 2.0, a new approach to the economy, and that very well may be true. It also might be a temporary thing in the grand scheme where a couple of years down the road, the rest of the world still doesn't have the same tech innovation we do. Market comes right back to where it was. Do you think there needs to be some tectonic shift, like in global economic leadership, for this to work?
I think all the drama that is implied in your very loaded question can be distracting. So what happened over the last couple of years is that those large cap tech names were really the only thing that was growing. You had some GLP-1 drugs and some other things, but basically that was, if you're a growth investor, that was the game, and it was a great game because they had real spectacular growth. So they deserved the attention they got. Everything else was sort of flattish. You had the Fed with the most aggressive rate hike campaign that it's ever had in the history of the United States, really slowed things down. Well, when the Fed stopped and other companies who've been rationalizing and basically cutting costs and looking for improvement started catching a gear, now you're seeing this year the S&P 500 earnings are supposed to grow at like 10%. But if you actually look at those smaller companies or the companies that didn't have much growth, they actually have mid to high single digit, in some cases double digit growth this year, which they haven't had in the last year or so. So it's really the improvement in aggregate of the other names. If you do the SPW, the equal weighted S&P names, you'll see a much different picture than if you look at the SPX or the cap weighted names. So that's really what it is, expectations versus reality. Expectations got too high for the mega cap tech names. They're still great companies and they're still going to grow a lot. And expectations were too low for everything else. And now we're just having normalization.
Very fair and a compelling point. I guess I just worry that so far these pockets of value outperformance usually happen in broader down markets, making it a situation of outperformance versus up. They have so far, at least. All the up markets have been beta driven. I would love to keep sparring with on the macro, and I love it, Eric, but tell me about some stocks. You got some picks for us. Hit me with some companies you like.
I'll hit you with that, but let me just get on the macro. You know, I've been around for 35 years. Your characterization of value versus growth, I completely disagree with. Value stocks typically perform well when the economy is growing slowly and they chug along, and the overly high expectations on growth stocks just aren't there.
Boy, I don't know. Growth stocks have done great when growth was very meager post-2008. I think if you go post-2008, is there a period post-2008, Eric, in which value stocks have led growth stocks in an up market?
Yeah.
Since you want to spar on macro.
The COVID shutdown, value stocks, I mean, we outperformed growth by 25% over that 3-year period. We crushed it.
Well, you guys are doing income strategies too, right? I mean, you're just, or is it pure equity?
Value with a catalyst and with a high yield. So that's the nature of it. So, but I think, you know, look, I'm not against growth stocks. I want to pay a fair price for them. When the multiple spread between value and growth compresses, you should buy growth stocks. Right now, it's still wide and it's contracting. And when it contracts, value stocks outperform.
Yeah.
And it's going to probably for another year. So a couple of the names that I like, I mentioned ADT in the notes. ADT, the alarm company. It's a $7 billion market cap company trading at less than 10 times earnings with double-digit earnings per share growth and a 2.7% dividend yield. Basically, the top line growth is only 5%, but a combination of greater efficiency, so they're getting higher margins, and share repurchases are going to give you double-digit earnings per share growth for the next few years. Normally, when you have a strong subscription model like that, it trades at a decent multiple, but this one, like I said, is less than 10 times. And if you just put a 15 multiple on it and you give it some of that growth, normally it's traded at 18 times multiple. It's an easy double. So that's one I think that everybody will recognize and like. You can ask me, you know, questions about the business if you want. The next one is also a really easy stock that you could get 50% out of.
Yeah, hit me one more.
Yeah, BERY Plastics. It's being merged with AMCR, another packaging company. And basically they do packaging for consumers and for medical products. So it's trading at 11 times earnings. BERY's the cheaper half to play. The dividend yield is going to jump from just under 2% to over 5%. And because of the synergies of the deal, you're going to see high single digit, maybe even low double digit earnings growth. And you put up just a 14 multiple on that and you get 50% upside.
Ooh, love that. Now we're talking. There's the juice. Eric, pleasure. Enjoy the conversation. You're welcome back anytime.